Job growth is treading water. We'll chat with economist Andrew Flowers next on the RegTech podcast. Welcome to the only podcast that helps employers and recruiters connect with more candidates through technology-inspired conversations. Mastering recruiting technology is the key to hiring great talent. That's why this show exists. Today's episode is sponsored in part by Dahlia. Is your CRM delivering the results you expected? Dahlia offers a free CRM audit to show you exactly how to turn those leads into applicants and hires. They'll reveal hidden gaps, compare your performance, and pinpoint what's truly driving applications. Don't leave the value on the table. Get your free audit at dahlia.co/regtechcrm. And by Jobcase. Jobcase is workers ready when you are. They have 120 million hourly, skilled, and gig workers in their network and community, which means filling high volume jobs is faster than ever before. So go to jobcase.com/hire and learn more. All right, folks. So today we're going to dive deep into the latest numbers of the job market. The U.S. labor market is treading water right now. While 139,000 jobs in May came out, this might sound okay. The reality is job growth has slowed to its weakest level in over 13 years, which I didn't realize. We're talking about how the lowest average monthly gains since late 2011. What's driving the slowdown? What does it mean for our economy, especially with sectors like healthcare and hospitality really carrying the weight of that job growth? Joining me now to discuss today's job market is the chief economist for Appcast, Andrew Flowers. Hey, Andrew.
Hey, it's great to be here. Thanks for having me, Chris.
Excellent. Your second time on the show, I think. We talked to you a couple of years ago
Yeah.
about the job market, but let's dive into this here because it's the last couple of years kind of been it felt like been treading water. But from a recruiting standpoint, what does that signal for employers and hiring platforms out there heading into the second half of this year, do you think?
Yeah. So when I talk about the labor market in the United States, quote unquote, treading water, what I look at is the data on the average monthly gain in non-farm payroll employment, which sounds like a mouthful, but basically it means for people who are actually on payrolls at employers, so like W-2 workers, and excluding the farm sector, the average monthly gain in employment over the past 12 months in the US has been around 144,000, right? Which on the surface it doesn't sound bad. 144,000. Oh, that's not too bad. And in May, when we got the May jobs report for that month specifically, we added 139,000, right? So for that specific month. So not that different. But what we need to kind of zoom out and focus on is over the last, say, 15 years, other than the kind of sharp drop in job growth during the pandemic, which was like a short and brief but very deep recession, right? We all remember in 2020. Other than that kind of pandemic-induced anomaly, this level of job growth is actually the slowest pace in about 13 years, a little more than that since late 2011. And so what I'm seeing is that it's not just that the pace of job growth is starting to tread south, as we kind of exit this post-pandemic period where we had the really sharp drop and then the really sharp rebound. What I'm starting to see is that the foundations of that number, that 139,000 number in May, are actually weaker than they seem, both because of the concentration of job growth in a few industries, but also just because of the revisions to prior months. So every month when the jobs numbers come out, so in May, it's not just that we got the May employment report for what the jobs were that month in the US. We also got revisions to April and the month before March. And those 2 months were sharply negative, down by 95,000. So this tends to happen, right? It happens on both the upswing and the downswing, right? Where the US Bureau of Labor Statistics is collecting more and more survey data from businesses, and they assess the prior month's numbers to either be on the upswing when the economy is really growing. They assess those numbers to be higher, so they revised upward. Or in this case, in March and April, they revised downward pretty sharply. And so all this to say that when you look in under the hood, so if the labor market is a car, we pop the hood and we look, the surface may seem okay, but I have some concerns that there are kind of issues with the engine under the hood. And so
Mm.
that's why I say the economy is heading towards a lower level with risk that point to the downside. And that's why the economy is just, quote, treading water right now. We're not drowning, but if things get any worse, it's going to be a problem.
Yeah. It's kind of fascinating how those two sectors, healthcare and hospitality or leisure and hospitality, are just always lead the job numbers. How long has that been, Andrew? And do you foresee a time where they're not at the top, the leaders of those?
Yeah, yeah. So it's a great way to think about it. Like these big, broad sectors, right? So post-pandemic, Which sectors were growing? Every sector was growing really in 2011 or 2021 rather, and even early 2022. We saw really strong job growth across the board. But then when interest rates began to rise sharply in 2022, and the economy began to kind of normalize after COVID, really there were three big sectors that were driving job growth for the past 3 years. And one of them is healthcare. And actually, healthcare continues to be the kind of linchpin of all the job growth. It's roughly over a third of all job growth in the last 2 years has been from healthcare. So healthcare was one foundation. The other pillar was all the leisure and hospitality jobs that we were still kind of overcorrect. We were kind of catching up from the pandemic for. So these are leisure and hospitality. What I mean by that is basically like restaurants and hotels, right? And so those jobs were still being kind of recouped from the big sharp decline when people, during lockdowns didn't go out and spend money and travel was slow to rebound in the year or two after COVID. But by 2022, leisure and hospitality was adding a lot of jobs as they did in May. But then the third sector that really led job growth the past 3 years was government, right? Government, both at the state and local level, rehiring teachers, doing infrastructure projects, but also at the federal level, government was a big source of job growth the past 3 years. And so that was kind of somewhat worrisome to economists like myself, assessing the labor market growth over the past 2, 3 years. It's the foundations of it have whittled down to those three. Well, what happened this year is we're kind of down to two, right? With federal government cutbacks, I think we've seen in headlines that the Department of Government Efficiency, DOGE, led by Elon Musk, it's starting to have a real impact. At the federal level, we've seen now 4 straight months of negative job growth. And in May, it was 22,000 job decline in terms of federal employment. So that's one area that's one pillar that has really been removed, right? All the kind of stimulus funding and grants to states to do infrastructure projects that were so strong during the years when President Biden and Congress spent a lot of money at the state and local level, those jobs have kind of stabilized. And so I would even say that it's a little bit at risk to going down to one pillar or even zero. And so what are my arguments for those two pillars? Well, for leisure and hospitality, all this kind of discretionary spending that you do when you go on a vacation or you go out to eat to a restaurant, that is at risk. Why? Because we can talk about this later, but tariff policies are likely to introduce price increases. And I think there's a lot of uncertainty in the economy right now. And so consumer spending, I would expect, and we've seen this in recent data, when you see through the buildup of sales of goods to get ahead of tariffs, when you see through that, we're starting to see some weakness now, both with retail sales and with kind of discretionary consumer spending. So that's an area where leisure and hospitality jobs could taper off in the coming months. And then even healthcare, which again, healthcare is so strong, adding over 40,000 jobs each month for the past year. However, there are impacts on the policy front too, as well, with potential Medicaid cuts. So I will say that the base of job growth, one way to think about it is in the monthly employment report, the Bureau of Labor Statistics, the BLS, they put out this idea of a diffusion index, which is basically saying how many industries are adding jobs versus how many what share are shrinking. And that has reached the lowest point or tied for the lowest point this cycle since interest rates really began to rise. And so we're starting to see this base of job growth really narrow and with policy impacts that could potentially suppress those sectors as well.
So more industries have less job growth than do
It's roughly 50-50 right now because
50.
so
Okay.
right now as many industries are shrinking as many as are expanding. Right now
Okay.
it's exactly almost 50, the diffusion index, which means that basically the number of job industries shrinking equals the number that are growing. And so that's where we're at risk of it going below 50 and a majority of industries are actually shrinking.
Yeah. Interesting. Let's talk about labor force participation for a second. Prime age workers slipping to 83.4%. Explain that first for the audience, and what factors do you
Yes.
think are keeping people on the sidelines here?
Yeah. Okay. So when you're in talent acquisition and recruiting, and you're thinking about the talent pool, right? One way to conceptualize that is the labor force, right? That's everyone in the U.S. who either has a job. So these are kind of like maybe passive candidates that you'd poach for a position. But the labor force also includes all the unemployed folks who are actually actively searching in the past 4 weeks. And so when you add that up, that's the labor force participation rate. And then one way to kind of slice this onion even further, Chris, if you're a recruiter or a TA leader, is to think about prime age workers, right? It sounds ageist, but it's not. It's what demographers refer to when they say, okay, the main working age population, the 25 to 54-year-old cohort over time, which we track to kind of adjust for, aging societies as baby boomers now are near or at retirement. And so when we look at these prime age workers, their labor force participation has slipped a bit. You mentioned 83.4% since last summer, it was at 84. So it's come down a bit and it's heading in the wrong direction. But one way to think about it is okay, it's still higher than what it was in the pre-COVID period. We'd actually have to go back to like the late 1990s to see a period of labor force participation rates this high among prime age workers. But what's driven this increase post-COVID in labor force participation is two groups. One, prime age women, their labor force participation is at an all-time high. Okay. But the other group is foreign-born workers, so immigration. And so what you ask, and when we talk about like recruiters and thinking about the talent pool, even though the participation rate's at a somewhat high level, but it's trending in the wrong direction. Again, this is where we have to kind of use our kind of awareness of public policy impacts because we know that this second Trump administration is really focusing on being more restrictive in terms of immigration policy through both legal channels, but also having better border enforcement and having fewer undocumented or illegal workers come to the country. And so we know that that supply, that immigrant, right, that channel was one of the two big drivers of this. That this participation rate is likely to keep sliding downward. I would bet if I was a bettor, I would bet that we're going to continue to see a slippage in labor force participation because foreign-born workers are either being discouraged from coming in or we're deporting the ones that do tend to work at higher rates in the country. So that's the kind of mapping of the talent pool that I think, given population aging and given higher restrictions on immigration, we're likely to see talent pools shrink. So if you're in TA and recruiting, that's going to be an increasing challenge. Even if the economy is weakening and maybe there's a bit of an uptick in unemployed workers, right? Just the pool of people, the supply in terms of the pipeline is starting to go down. And so with that in mind, I think we can't ask more for women. Again, prime age female labor force participation is at or near an all-time high. It's near an all-time peak. So I think that's where the pool of labor is going to get more scarce in the years to come.
Yeah. It begs the question, we still need, a thoughtful immigration program to bring the right workers into the country. We can't just throw them all out, so, but I digress there, but
Yeah.
what about quit rates, Andrew? Are they still pretty low right now? People kind of still hunkering down, just kind of waiting out the market?
Yeah, so quits rates, when we talk about like the great resignation, right, which is all-time peak in quits rates back in 2022. And it really started to rise in late 2021. That was very true. That dynamism of job switching of people who are workers quitting, often for another job, often with better pay, that happened a lot in 2021 and 2022. Well, it's been steadily declining, and so much so that it's actually overcorrected. I would actually say we've pivoted far from the Great Resignation to the Great Stay, where quits rates now are quite low, lowest, far lower than their pre-COVID level. And so I would actually say job seeker activity among the passive candidate pool of people who are already employed, among people who have a job, so workers' inclination to maybe quit for another offer is really down right now. Their quits rates are down because, frankly, their concerns are up a bit about the future path of the economy. So what this has now is it's interesting. It's quits rates are down, but so are hire rates, right? The rate of hiring that's happening in the economy is down at its lowest point in over a decade, right? So why we're able to add these jobs, remember, because I talked about how at the surface, it seems like we're adding, 139,000 jobs in May. We're adding 144,000 jobs per month on average the past year. Well, what's driving that growth in employment is often there's fewer people attriting. When I talk about attrition, I'm talking about quitting, either separating out of the labor force or quitting for another job, or even layoffs. Right, layoffs are very low. So this great stay that I mentioned is very different from the great resignation. Right, so quits rates were really high. Now they're very low, but also hire rates are very low. So even though the unemployment rate seems good, it seems good at 4.2%. It's really kind of a frozen labor market because employers are neither hiring much nor firing much. and job seekers aren't going anywhere. So that's how we're adding more people, is that fewer people are quitting more so than we're like net hiring a lot of people. Because
Yeah.
roughly two-thirds of all hires, this is a mind-blowing stat, Chris. Roughly two-thirds of all hiring done in the US is for backfilling positions where someone left. Well, how do people leave? They're either, laid off or they quit. But both of those rates are actually really low. Despite what you hear maybe on LinkedIn and see with a few tech giants a few years ago, there were some layoffs, headline grabbing layoffs. The layoff rate as well is below its pre-COVID average. So everything's kind of frozen now. That's what I mean when I say the great stay. And
Mm.
we'll see strength in the labor market return when the quits rate starts to rise.
Interesting. So two-thirds of all new jobs are backfill jobs.
Two-thirds of all hiring is done to backfill someone leaving a previous position, rather than growing the net total employment levels at that company, at that
Mm.
organization.
That's pretty fascinating. Looking ahead, Andrew, what's the well, actually, you guys at Appcast there do a lot of programmatic job advertising. How does this whole weak job market sort of affect the efficacy of job advertising and programmatic there? Talk a bit about that.
Well, I think our solutions to talk about Appcast business and what our technology does is we help, distribute and optimize recruitment media across any given channel. Could be Indeed, LinkedIn, ZipRecruiter. We're channel agnostic and we're driven by data. So because our technology essentially connects with an employer's ATS, categorizes their jobs into groupings by region, by occupation, distributes them to the right channels where they'll find the best candidates, whatever that may be, both programmatic or the job board channel, but also search and display, or also social, or also other sources. And so our core technology, what it does is, because it's so data driven, I think it thrives in this world of high uncertainty that we're talking about, right? Whether it's immigration policy. Immigration policy is not going to like affect every industry equally, right? It's not going to affect, say, even healthcare or consulting as much as it's going to affect manufacturing and construction. And so our tool really kind of is able to, through our talent insights features, identify the gaps in talent in terms of the mismatch between demand and supply for that role in that market, right? So when we're talking about like a cashier in Chicago or a neurosurgeon in Las Vegas, it's the same concept of like, well, what's the talent marketplace telling us in this environment of high uncertainty? What I expect is that for our platform, given the weakening in job growth and the headwinds to the economy with tariffs, I would expect recruiting costs to dip down a bit, or at least not rise back to their higher level of 2011, 2012. So when I say recruiting costs for the TA and HR leaders here, I'm talking about cost per impression, cost per click, but then down that funnel, that post-click activity, cost per qualified applicant, cost per hire, right? When you look at the kind of down funnel metrics where you're seeing, okay, how are my recruiting teams dispositioning candidates through our ATS, our applicant tracking system? How are we kind of, remarketing through our CRM to, silver medalist of the past? When you want to say how much ad money does that cost in terms of the talent marketplace, those recruiting costs I expect to stay flat, maybe even decline a bit if the economy weakens, as a lot of forecasters expect.
Yeah. I think one thing I'm hearing from the other vendors as well is just applies are up across the board. You guys seeing that as well there at Appcast?
Yes, and that's also both a phenomenon of um, you know, the low hiring rates happening, so young college graduates is a great example, right? Young college graduates normally historically have had a better time getting jobs historically. The past, say, 40 years, typically the college graduates who are, say, under 30, their unemployment rate's lower than the average unemployment rate. But right now it's much higher at 8.2% young college graduates. And so if you're newly entering the labor force, the job finding rate's really low. That's just the probability of you going from unemployed to employed. And so the people who are just finding it hard to break into this job market that's frozen, right? Because higher rates are down, but also layoff rates are down and quits rates are down. If you're a young college graduate, or say you're an immigrant, or say you took time off to do child care or elder care, and you're reentering the labor force, you're looking for work. The job finding rate is around 25%, which is way down. It's been trending downward. So all these stories you hear about people, who are bright young college graduates, or even just unfortunately, unemployed people on LinkedIn who are like, I'm applying to hundreds of jobs, right? That's the function of that's one of the two big functions behind the surge in applications we're seeing, right? So more applications just is more irons in the fire. It's more shots that you take as a job seeker to try to land a new job. Applies sometimes to hundreds of jobs. So that's one big force, right? This kind of frozen economy where the new entrants to the labor force have to apply to lots of jobs to break in. It's really hard to get a job. But the other force, I dare not, right? I dare not neglect. That's also behind this surge, this avalanche of applications, of course, is generative AI. And we see a lot of agentic AI tools, which are basically action-oriented large language models that take instructions from a job seeker. So they will say in natural terms, go to my LinkedIn profile, or here's my resume if I have one, or if not, create one for me. Create a profile for me, a templated cover letter, here's my backstory. And then these agentic AIs will essentially go and find jobs for people and apply to them at scale. And this is happening as we speak. And so the second channel, besides the kind of frozen job market, the great stay that I mentioned, that's a big part of why applications are up. The other thing is that agentic AI is driving the tech is driving AI driven applies. Now some people in our industry may think, well, is that fraud? Is that are these quote unquote bot applies? Are they just bad news that we got to kind of whack? Well, I think it's not quite that cut and dry. I think there are some potential for agentic AI fraud to increase, just given the nature of the technology. We're wrapping our heads around it. But also, it's just maybe it's a good thing from a job seeker's perspective, right? If you are that person trying to break in, you're applying to hundreds of jobs. These tools really help you do that at scale.
Yeah, for many job seekers, it's a numbers game for them, and they don't see any way out of that. I'm hopeful that AI can finally fix the resume black hole, Andrew, one day, but we'll see here. I think it has potential to do that,
I
so
hope so.
that job seekers don't have to spray and pray their resume all over the place. But we'll see what happens there. Well, we're talking with Andrew Flowers, of course, from Appcast, chief economist there. Looking ahead, Andrew, one thing I feel like my prediction is that we've seen peak staffing in a lot of industries today. And I want to get your thoughts on this. I think we've seen peak recruiter staffing at companies because AI is going to help them do more with less. Probably seen peak tech staffing, but what's your sense of that, and how should talent tech companies and TE leaders prepare for it?
Yeah, I know this is, it's hard for me to, as the bearer of bad news, right? Sometimes to the kind of HR, TA world, when I do look at the job postings that are out there for HR
Mm.
roles,
Mm.
they are down. They are down. So if you think of like 100 equals the pre-COVID mark, so before COVID, February 2020, or say the whole year 2019, if we kind of index job postings to that kind of pre-COVID level, we saw during the early years of COVID just an explosion of job postings for all types of roles, right? But for HR specifically, actually, HR was one of the biggest
Yeah.
leaders in terms of companies were trying to hire lots of people of different roles. And of course, so who do they hire first? Maybe HR and TA leaders, right? And what we saw since 2022 at that peak in that spring when interest rates began to rise, we've seen a huge collapse in job posting demand for these so-called, I would say, a better term than white collar is sitting down jobs. So people who are like a laptop class person who like,
Mm.
and I'm in this group, right? So this is someone who is doing, it could be customer service on the lower paid side of that spectrum, or it could be consulting, finance and banking, software developers, sales, all the marketing, HR, all those so-called white collar roles, corporate roles, however you want to describe it. These sitting down jobs are way, way depressed right now. Their job postings are, if 100 was pre-COVID and some of them peaked at 180, 200, they're now down in the 50, 60, 70 range. So they're well below 30%, 20% to 30% or more below the number of job post openings in those occupations. Now, why is that? Is it because AI is taking the roles of recruiters? Maybe a little bit. I think what you said is true. Like, definitely a lot of companies are being asked to do more with less. But it's really because white collar hiring as a whole or sitting down job hiring as a whole is depressed, right? So think about the major job groups that I talked about earlier. What were the pillars that were kind of leading job group? Healthcare, leisure and hospitality, and before it really kind of slowed down, government, which often was state and local government teachers. So
Yeah.
people doing those, what's the opposite of sitting down jobs? Standing up jobs. Those kind of like direct care providing jobs as a healthcare, as a nurse, or as a teacher, or as a waiter. Those are the jobs that have added a lot of employment in recent years. And so what I'm trying to get at here is that this world of HR and TA staffing is at a kind of a nadir. It's at a depressed point. And I think some people are scared, oh, it will never recover. We'll never get these jobs back. AI is going to automate all our jobs. I don't think that's true. I think there is definitely going to be more efficiency and more automation. More TA focused tools are going to be agentic AI tools where it's like they help a few recruiters do more with less. However, I think the bigger reason these roles, whether it's HR, software developers, or any of these other sitting down jobs, the reason they're depressed is interest rates. And we can get into that maybe in a different podcast, Chris. But really, with high interest rates, it makes corporate companies less reluctant to hire these headcounts that are paying investments largely in the future, right? Whereas if you hire a new waiter or a new cook or a new manufacturing line worker or a new construction worker, you're making money on a net present value right now. So with high interest rates, those are the sectors that are adding jobs: construction, nursing, any of the direct care providing jobs versus the white collar jobs. I do think they will rebound eventually. The HR jobs will come back, the marketing, the sales jobs, the consulting jobs will come back. It's when interest rates begin to decline and come down that we'll see a boom in those white collar or sitting down jobs.
Awesome. Well, it's been a fascinating conversation, Andrew. Appreciate you stopping by today here at RecTech. Always good information from you, and you're a great guest.
Hey, Chris. Hey, thanks for having me. This has been a great pleasure. And for the whole RecTech audience, yeah, please check out appcast.io. If you'd like to learn more, it's been a pleasure being here.
Excellent. All right, that will do for this episode of the RecTech Podcast. Thanks again to Jobcase and Dahlia for the sponsorship. Be sure to follow myself and RecTech Media on LinkedIn to see every podcast, video, and blog that we publish. Thanks for tuning in, everyone. And remember, always be recruiting.